Hey everyone, thank you for attending the Place Your Trades Network Spaces to discuss macro commodities. This Spaces is brought to you by TraderVate, which has a custom web app dedicated to trading CME Group's new daily option contracts, including indices, energy, metals, and now Bitcoin. And you can now trade these on the DOM on TraderVate's main platform as well. They are a great way to get exposure to the futures market with limited risk. You can use the link in my Twitter stream to go and get the TraderVate app for free. I also write a weekly blog and daily pre-market overview on markets that you can subscribe to at placeyourtrades.com. It's absolutely free. And I will be doing a summary of this episode with my key takeaways that will be available to download as a PDF. If you're interested in getting this PDF, please click on the link in my feed or visit placeyourtrades.com/spaces to sign up for it. The PDF overview will be available and emailed out tomorrow to anyone who signs up. And I'll put a link in the nest as well. So first, I'd like to introduce our guests. We have Velina Tchakarova, which I can never pronounce her last name. Sorry, Velina. She's CEO and founder of FACE, with over 2 decades of professional experience and an academic background in security and defense. Velina is an expert in the field of geopolitics. As former director of the Austrian Institute for European and Security Policy in Vienna, Austria, Velina has a wealth of knowledge and expertise in analyzing the geopolitical landscape and its impact on businesses and organizations. She's currently serving as an instructor at the Real World Risk Institute, a member of the Strategic and Security Policy Advisory Board of the Science Commission at the Austrian Federal Ministry of Defense, and a peer board member of the Austrian publication Defense Horizon Journal. At FACE, Velina utilizes her extensive network of experts and real-world expertise to offer customized solutions for clients to navigate the geopolitical landscape and make informed decisions. She helps clients plan for potential risks and trends that may arise from geopolitical environment of their country, region, or sector. Next, we have Peter Boockvar. Peter is the Chief Investment Officer of Boockvar Financial Group, $8 billion wealth management firm. He is also editor of the book report. He previously was the chief market analyst for the Lindsay Group, a macroeconomic and market research firm started by Larry Lindsay. Prior to this, Peter spent a brief time at Omega Advisors, a New York-based hedge fund, as a macro analyst and portfolio manager. And before this, he was an employee and partner at Miller Tabak and Company for 18 years, where he was the equity strategist and portfolio manager with Miller Tabak Advisors. Peter graduated cum laude with a BBA in finance from George Washington University. And last but not least, we have Chuck Berry, who's president of House Mountain Partners, LLC, based in Washington, D.C. Chris has been an independent analyst for the past 13 years with a focus on battery metal supply chains, including lithium, cobalt, graphite, nickel, copper, vanadium, and rare earths. His work supports a roster of global clients, including investors in mining companies, oil and gas companies, and EV manufacturers across 6 continents. His advisory work has a special focus on how battery metal supply chains are evolving to create opportunities and threats during this energy transition in the coming decades. Before shifting focus to analysis of these trends, Chris gained 12 years of capital markets experience on the both buy side and sell side. He's visited and performed economic analysis of metal deposits on 6 continents and featured in multiple media outlets. Chris holds a Master of Business Administration in Finance with an international focus from Fordham University and a BA in International Studies from the Virginia Military Institute. And with that, we will get right into it. Thank you, all of the panel members, for taking time out of your day to come talk to us. I'm sure everybody really appreciates it. I know I do. And so first we'll start, and we're going to do this in a round. I know not everybody's been on my spaces before, so nobody's sitting, not talking for a long time. We'll do 2 rounds of questions. and then final round. So we'll start with Velina. Velina, so after Russia pulled out of the grain agreement last week, which entailed ending the Ukraine exports from the Black Sea, you posted that you had discovered a loophole in the current shipment system. Can you tell us what you found and the implications?
Hello, Tracy. Hello, everyone. Thank you very much for the invitation. And I would like to draw your attention to the most recent developments regarding the Black Sea Grain Initiative and Russia's withdrawal from it per July 17. And there have been a very, very solid analysis and assessments afterwards, pointing to the alternative lines that are linked to the Danube River, which entails both rail and obviously also the maritime line. And here I found, I discovered a loophole in the system, which I want to shortly outline for you. Now, first point, the so-called Danube option or alternative for Ukraine has been launched following the beginning of the war in March. So the first conversations began immediately afterwards. As you probably know, in fact, Russia blocked the Ukrainian ports and Ukraine, as you also probably know, but for those who don't know, is wheat exporter number 5 in the world. And the key Ukrainian ports were in fact blocked by Russia even before the war began on 24th of February because, they used this as, so to say, as an instrumentalization of the geoeconomic warfare. So they blocked them already a few weeks before the beginning of the war, and that, of course, unleashed a lot of conversations within the European Union, how to actually create these solidarity lanes. So the European Union solidarity lanes are actually not only crucial for the exports of the Ukrainian agricultural goods, but they are currently, and I want to highlight that, the only option for exporting other Ukrainian goods, and also the only option for Ukraine to import all the goods it needs. So think of humanitarian aid, think of a lot of the military aid that is going to Ukraine, but also think of fuel. So far, more than 40 million tons of grain, oilseeds, and the related products have left Ukraine through the solidarity lines. This is how they are called. So think of this, the new line, as the solidarity lanes. They enable the export of around 60% of the Ukraine's grain. So 40% of the Ukrainian grain has been exported via the Black Sea Grain Initiative. As we meanwhile know, this is around more than 33 million tons, and 60%, another 60% went through these solidarity lines. Now, one of the main theses is that following the withdrawal of Russia from the Black Sea Grain Initiative, the Danube solidarity lines should cover for the whole of it. Why? Because we have shrinked volume of Ukrainian grain. Some say that Ukraine should be able to ship around 40 million tons of grain without the Black Sea Grain Initiative. And the NUP should be more or less enough. But my argument, so I argue that this is not going to be the case. First and foremost, because, as I said, the solidarity lines have also helped to export over 35 million tons of non-agricultural products. So you need them not only for the agricultural production. And second, because it also is the only way how to import goods from the European Union. Second important point is costs. Obviously, this is still underdeveloped compared to the Black Sea ports, to the 3 key Ukrainian ports. Let me highlight that the Black Sea is in fact the most important global choke point for this kind of commodities, specifically for wheat, for instance. So you can imagine what happens every time when there is any kind of blockade, as it happened immediately. And as I said, ahead, in fact, most of the observers didn't see it actually happening before the war began. But okay, let's say after the beginning of the war, the first blockade that happened until the Black Sea Grain Initiative was negotiated and launched officially in summer last year. So here my point is that what Russia has been doing for the last 4 to 5 days is a very deliberate and concrete action. It is mostly about economics and not so much about geopolitics. And here, Russia has very concrete goals that it wants to achieve by doing so. So it has not only withdrawn from the Black Sea Grain Initiative, it has also, and there is plenty of material. Meanwhile, investigative journalists have also posted a lot on that. You remember the Kakhovka Dam, which also led to a precarious situation, specifically for the arable land and for the irrigation systems in the south of Ukraine, which will affect also the agrarian production. The third point is that over the last 3 months, in fact, the three key ports in Ukraine haven't been shipping almost any volume of grain from, practically through the Black Sea Initiative. So there has been a lot going on already. It has been a lot in the making over the last several months. And now we are actually observing the manifestation of this instrumentalization of Russian geoeconomics. And the main idea here is to create enough pressure to escalate to the point that the European Union, mostly the European Union, will agree to include Russian banks, important Russian banks that are required for the Russian volume of grain and also for the fertilizers to be re-included into the SWIFT system. So here it is really mostly about geoeconomics first and foremost, but of course it is very much also linked to the goals of the war. So final sentence on my side is that what we are going to observe is further escalation now affecting more and more the Danube solidarity lines for obvious reasons, as I outlined. Thank you.
Thank you. And then staying on grains or food, but moving countries, it seems that countries are focusing on food security and food nationalization may be just starting as we saw India ban all rice exports except for basmati. So do you think this is going to be a trend and we're going to see more of this? And if so, what are the implications?
The question is still related to me, Tracy?
Yes.
Yes, okay. No, just
Yes,
because I talk too much and I didn't want to take too much space for our other guests. Yes, the repercussions are immense. I have been arguing, in fact, even before the official withdrawal of Russia from the Black Sea Grain Initiative, that Russia is practically triggering food crisis 2.0, similar to the scenario that it has instigated last year. Of course, earlier last year, as I said before, and then immediately after the beginning of the war. Wars are always inflationary, and this kind of economic instrumentalization of Russian commodities is very, very helpful. So, similar to the situation last year, this year again, through the increased pressure, first and foremost, indirect pressure on political decision makers to act here specifically. As I said, the targeted political decision makers are in Europe, not so much in the United States or let's say in the rest of the G7 countries, but specifically European Union because of the sanctions regime. The sanctions have been officially extended a few days ago. The European Union decided to extend the period of the sanctions by another 6 months. So they are officially valid until next year, beginning of next year, January 24th. That's the first thing. So second, sanctions are obviously increasingly biting. Yes, we can discuss that there are a lot of avenues for international cooperation for Russia, but here the indirect pressure that is building up is specifically linked to the global south, because Russia has uh, a lot of leverage over, first and foremost, political voting in plenty of international organizations, and second, as I said, through the narrative that the sanctions are causing the global famine, the global food crisis, but also the global energy crisis. And we can discuss this later a little bit. Also, that I still also argue that Europe is not far from energy crisis 2.0. Last year we were lucky because of several factors, but this year, once again, we should be very cautious about that as well. So all in all, it has a lot of true economic agenda linked to the geopolitics of warfare that Russia is currently, I would argue, efficiently instrumentalizing against the West.
Perfect, thank you. And yes, and I do want to get into Europe in depth a little bit more. But first, we're going to move to Peter. Peter, welcome. Thank you for being on
Thank you, Tracy. Thank you for having me.
Yeah. So I wanted to talk about home builders, because home builders kind of been going crazy, much to many dismay. But we haven't really seen this exuberance filter into commodities, say, copper, lumber, and things of that nature. So first, why is that? And second, can this trend continue with, rising mortgage rates? I mean, our home builders going to keep going crazy, especially with national home prices seem to be on the rise again?
Well, the thing with home builders is they're doing well because they're very profitable right now. Not necessarily because they're building an extraordinary amount of homes, but the homes that they're building are finally at a decent margin after the last few years of high labor costs, supply chain problems, and so on. So I think that's maybe one reason why there's not this like massive demand for copper, for example, from the builders. I mean, if you look at single family starts, to use that as an example, and actually today we got new home sales, which, with if you include revisions, were pretty much around expectations and not really much different than the average we saw in 2019. So for all that enthusiasm, like I said, the pace of home sales is no different than where it was in 2019. And just perspective, with single family housing starts, we're just under a million starts. We're about 935, and this was over a million. Actually, it was over 1.2 million back in 2021. So I think that's the perspective. And also, there's valuation expansion going on in the home builders. One of the rules of thumb doing this long enough is with the home building sector, you buy these stocks when they trade at 1 or under 1 times book value. And at least D.R. Horton, to use them as an example and a proxy, that stock's trading now at 2 times book value. So that's also sort of exaggerated the rally in home builders. And lastly, from a contrarian standpoint, everyone just hating them because of the intuitive belief that if the mortgage rates are at 7%, how can you sell any homes? And that obviously was not the case in this, what I refer to as an upside down housing market, where you have existing home sales that are near the lowest level. If you look at the weekly mortgage application data, the purchase component is near, not at, but near the lowest level since 1995. So we're at almost a 30-year low in the pace of housing turnover with existing homes, and the actual existing home sale number is pretty close to that. So, and then you have all these, the demand for home builders, but keep in mind also home builders are benefiting from giving you a discount. They're buying down your mortgage. They're giving you a teaser rate. They're giving you other type of discounts that's enticing you to buy a new home, where maybe you would have wanted to buy an existing home that you like because the neighborhood was better for whatever reason. So it's a combination of those factors, I think, that have helped the stocks, not necessarily, again, just the quantity of homes that they're building, which then ties into your commodity question. And I think that's why there hasn't really been a notable change in commodity prices in response to this.
And do you expect this trend to continue? I mean, we have, again, right, national home prices seem to be rising again after kind of a brief pullback, and mortgage rates still seem to be trending higher. So do we hit a wall at some point, or this can go on indefinitely?
It's an important question. I do think we do hit a wall. I don't think that there's an endless pool of buyers that are going to pay a 7% mortgage rate. Now, like I said, there's teaser rates that are being offered here for a couple of years to the buyers of new homes. Maybe they buy that down to 6%, but there's not an endless pool of people that can afford that. Just keep in mind, a big portion, or I should say an important portion of the home building industry in totality, including existing and new, is that first-time buyer. And without that first-time buyer, it sort of clogs up the chain of housing transactions, because the existing home buyer who wants to trade up, they sell their starter home to a first-time buyer, and with that first-time buyer can't afford it, then it clogs things. And with rates where they are, with prices where they are, like I said, there's not this endless supply of first-time buyers that can pay this money for a home. And I do think that there is a wall to be reached here, and I think we can actually be getting close to it. I think that you've had this pent-up demand, this sort of spring and summer season that to an extent is maybe being satiated from that new home perspective. So now I can't tell you when this wall is hit, but because we listen to a lot of home builders comment on their earnings, and they all seem to be pretty optimistic about what they're seeing. But they say, yeah, our buyers are becoming more comfortable with the current level of mortgage rates. And I'm thinking, no. You never become comfortable with their 6 or 7% mortgage on top of home prices that just went up 40% in 2 years. No one gets comfortable with that. No one gets comfortable with affordability near record lows when you look at the price of a home relative to one's income. You're straining to buy that home, but some people need to do it, and this is the choice that they've been given. And they cross their fingers and they hope that in the next couple of years they can refinance down their lower mortgage rate. But if they don't, and that teaser rate expires, and mortgage rates are where they are, and that teaser rate resets higher, then that's another problem. And then one last thing is, every day somebody's adjustable rate mortgage is expiring, and yeah, hopefully that they've got a lot more equity in that home, they've paid it down. But if they need to refinance into a new mortgage at a 7% rate from their 3 to 4 adjustable rate mortgage, that is a rate shock that they're going to have to adjust to. And you know what? On the flip side, maybe that adds to some supply, as these people can't afford to stay in that house. But just again, a lot of just strange cross currents in this housing market that monetary policy has created by trapping so many people into low mortgages when they create an environment of 15 years of essentially zero interest rates and then take them vertical all in 1 year.
That makes sense. You explained that very well. And then I kind of want to move on to agriculture prices as well, not only grain, but softs. For example, if you look at the CRB Foodstuff Index, it's been on a tear for well over a month. This obviously does not help the inflation situation. So can the Fed, or any ECB for that matter, tame this by more rate hikes, and how does this all factor into their plan?
Well, the interesting thing about ag is the demand side is always pretty easy to estimate. It is usually a linear progression upwards as the world gets wealthier, as the world sees more population. So the thing with analyzing ag, investing in ag, trading ag, has always been trying to figure out the supply side because of that steady pace of demand. And I don't think people are going to eat less if the Fed is more aggressive in raising interest rates. Maybe they sort of mix up what they're actually buying. Maybe they trade down, but somebody is still most likely eating during the day. So the supply side is always the the needle mover in terms of influence on the price of ag. So with the softs, and Velina touched upon it. Her focus was all on the supply side and how the supply side is being disrupted, which is leading to, like you said, this ripping higher in the CRB food stuff index. But then you have like cocoa, for example, which I think is trading at a record high today, and sugar prices that have gone up a lot. But a lot of that ties into supply problems. And because, again, that demand side is always steady. So whenever you get a supply shortfall, you've already sort of conquered in your analysis one side of that supply demand equation. If you get that supply side on your side, you're going to get much higher prices. Whereas energy prices and industrial metals, for example, there is a little bit more, well, certainly more so in industrial metals, less so in oil. There's more elasticity, where in ag, it's very inelastic when it comes to the demand side. And one last point, sorry, is there's also short cycles when it comes to ag. At least in the U.S., you have one planting season, you have one harvest. Now you throw in, because of the different seasons in South America, Brazil and Argentina, you mix that up. But, a bad harvest can be resolved the following year. So you just don't have these long cycles of supply issues that you would have in other parts of the commodity world. And that's why they're very much trades rather than investments. But yeah, there's no doubt that this, and also on the demand side, the rising middle class in Asia is a really big deal in terms of the demand for ag and their demand for food. And whether it's even in China's middle class is going to double in the next 5 years in terms of its per capita income. And India is a major growth driver for food and ag as their middle class grows. And in Indonesia and Vietnam and Thailand, these are all demand push stories that if the supply, for whatever reason, cannot keep up, ag prices go higher.
So do you think that leads to kind of what I was talking about before do you think that leads to more sort of food nationalization, as we just saw India banning rice exports, except for basmati? Do you see that as, part of the future, that we're going to have more and more countries kind of protecting their domestic supply?
Yes. Just as also like Indonesia, for example, is trying to protect their domestic nickel supply, for example. Yes, and the irony, of course, is that that's only going to result in potentially even higher prices, as it is a form of sort of price control, supply control, and that then can disincentivize other production. So yeah, it's going to happen. The politics of it are great. On paper, you can say, yeah, we need to keep this for ourselves, but the further distortions that it creates keeps prices elevated, and probably even more so.
So something to be looking out for certain. It seems kind of like a vicious cycle.
Yeah, and you still have a few billion people that aren't eating necessarily 3 meals a day. So the impact of much higher food prices is pretty profound.
Well, thank you. And we'll come back to you because I still have some more questions, but let's move on to Chris really quickly. I want to talk about energy transition materials, minerals. So first of all, what does kind of the overall supply demand situation look like? Because it seems like these 2030, 2035, and 2050 goals are pretty ambitious. I mean, are they actually attainable?
Sure. Thanks, Tracy, for the opportunity. And thanks, everybody, for coming in today. Long-time listener, first-time speaker. So this is great to be here. The short answer is no. Okay. Depending upon your time frame, most of these decarbonization goals or these temperature limit goals are probably not attainable, just based on the fact that it takes, quite frankly, not months, but years to bring new greenfields metal supply on stream. And when you look at the size and scale and scope of the types of metals, and also just the sheer amount of different metals that we are going to need to successfully decarbonize. And I'll leave that open to how you define successful decarbonization. We're moving in the right direction, but again, it's really not a question of, oh, there isn't enough lithium in the Earth's crust, or there isn't enough copper out there. There definitely is. I mean, the interesting thing about this whole sort of critical metals narrative is that I think there's a view that a lot of these metals are rare, and they're not. Okay, it just has sort of become an economic question about how do we profitably, we as a sort of a mining company, how do you profitably extract them and out of the ground and refine them? Okay, and to Peter's point, you are seeing governments, not just Indonesia on the nickel side, but Chile with lithium, Namibia with lithium, rare earth elements. I mean, you're starting to see governments basically saying no more exports of our, the people's lithium, right? And so they want to capture more of the supply chain. And again, just to sort of echo Peter's sentiments, something I really agree with is that you're likely to see higher metals prices rather than lower metals prices as you start to see government interference in these markets going forward. And of course, that has implications for how quickly we can decarbonize. And again, what the true economics of decarbonization and electrification look like, I think, at the end of the day. Just to give maybe a little bit of perspective, if we just take a look at lithium, okay, that's kind of the belle of the ball with respect to the battery metals. Okay, so today it's around a 950,000, maybe 1 million ton per year market. Okay, so that's obviously very small relative to nickel or even copper at 24, 25 million tons a year. Lithium demand, I think this decade out to 2030 grows by about 20% per year on a compound annual growth rate basis. What that is going to mean in terms of raw numbers is that we need to bring every single year 140,000 tons of new lithium capacity every single year in order to match that 20% growth rate. Because again, demand is really quite strong, even in the current environment, with lithium pricing softening rather dramatically in the last 6 months. And so a typical lithium mine, whether or not it's coming from brine resources in South America, hard rock sources in Western Australia or other parts of the world, a typical lithium mine has usually produced around anywhere from 20 to 30, maybe 35,000 tons of material per year. Okay, so what I am suggesting is that should I be correct and demand grow at 20% a year out to 2030, you're looking at roughly 4 to 5 brand new lithium mines to come on stream every single year out to 2030. And that's just lithium, okay? We can have a separate conversation about copper, about nickel, about rare earth elements that go into magnets. Outside of substitution, outside of technology advancements around lithium extraction or recycling, it's just going to be really difficult to hit, again, some of these aggressive numbers around decarbonization and maybe limiting temperature that you see out there. So, I'm not saying we throw in the towel and forget about it. I mean, I do think that we're headed in the right direction, but there's sort of been a reckoning, I think, or a realization along the supply chain or along stakeholders, whether or not it's government companies, automotive manufacturers, that, you don't just turn a knob or flick a switch and more lithium appears or more copper appears, especially when demand is growing at 20% a year. Again, just for the sake of historic kind of where things were versus where they are today, lithium demand typically grew around 6% year over year for decades, and it was an oligopoly. And now, obviously, like I said, it's much bigger. And that just raises a lot of questions about how we decarbonize, right? And perhaps we can get into some issues with the Inflation Reduction Act and what the EU is doing with their Green New Deal. But I think the paradox there is while this legislation coming from governments is designed, it's well-intentioned, right? We want to decarbonize. We want to rejigger supply chains and ignite another industrial revolution. What it's going to do, in my view, is really supercharge, if you'll pardon the pun, demand for some of these metals. Again, lithium and copper, I think, are two really interesting ones longer term. And so, again, that becomes a challenge. How do you decarbonize when it's not going to take less lithium or less copper? It's going to take orders of magnitude more in order to successfully do it. And again, this is kind of the pragmatism I think that is missing in this debate. And what some of this legislation, like the Inflation Reduction Act, kind of misses, to be honest with you. I'll just say one more thing and then I'll pause. Again, with respect to the IRA, I mean, it is incredibly economically beneficial to build a battery manufacturing plant here in the United States, or a recycling plant here in the United States, or a cathode or an anode facility. The IRA, again, does not address, in my opinion, it does not address the raw material challenges to feed these plants. Okay. And so, it's great to say, we're going to build Panasonic's going to build a battery manufacturing facility in Kansas, and they're going to get, hundreds of millions in subsidies and tax breaks and so on and so forth, billions, to be honest with you, over the life of that factory. But where is the raw material going to come from? Okay. Because again, it takes at least 10 to 15 years to build a greenfields mine of any kind here in the United States. And then again, when you look at the IRA and you say, all right, so we'll just rely on Chile or Argentina or Australia, our free trade partners. Actually, we don't have a free trade agreement with Argentina, which is a slight issue. But again, coming back to my original point, all of these countries, and Peter's point, all of these countries are developing their own internal critical metals kind of supply chain strategies. And it doesn't involve sharing. It involves keeping more of the raw material on shore, and as opposed to just mining raw nickel or mining raw lithium and then exporting it to Asia or wherever, it involves more of that value-added activity on shore. And so again, pricing, I think, has to rise, right, outside of substitution or some sort of giant technology leaps. And with respect to batteries, I have this Google alert set up, and I can't remember, it says something like battery breakthrough or battery technology, and every week there's a new breakthrough, right? It's a spray paint graphene battery, or it's sodium ion, which is actually a real technology. But there are these every week I get a new breakthrough that's going to revolutionize the industry, and costs are going to zero. We don't have to worry about raw material challenges anymore. And, it gets a little bit of buzz in the press, and then you don't hear about it for 10 years. Okay. And the reason is because it takes that long to scale up and commercialize this technology. So, I don't know. I don't want to be too negative here. I'm just trying to lay out what I see happening over the course of this decade with respect to efforts to decarbonize, as well-intentioned and well-meaning as they are. It does come at a cost. And I think we're just realizing what those costs are along the supply chain.
Well, and you did kind of touch. My next question was kind of the current problems facing the U.S. and Europe over the IRA Act and Europe's version of this, and you pretty much answered that. So I'm going to move to my next question, because you brought up, dealing with other countries as far as mining is concerned, because it's difficult to get, raw material mining up and running in Europe or the U.S. for that matter. So I kind of want to talk about supply chains as it has to do with, in Africa, actually, right? So basically the question is, let's talk about battery metal supply chains as the U.S. and China kind of wrestle for influence in Africa, and particularly for lithium. It seems to me that the U.S. is late to the game here. So can we even compete with China and even Russia's growing influence?
Yeah,
as it has to do with Africa.
Yeah, with respect to Africa, I mean, the Chinese, quite frankly, have been all over Africa with a focus on resource extraction for years, if not decades. Copper, I think, is one of the most notable examples. But I had done some work in Namibia a number of years ago, and you sort of drive along these roads and you drive by these uranium mines, which is one of a major export of Namibia, and the name of the mine and the name of the company is there in English and it's there in Mandarin. Okay. And you're in an African country. So, to your question, can we in the United States compete? Are we late to the game? And we are late to the game. Okay. There's just no way around that. I mean, I guess a few months ago, the Biden administration dispatched Kamala Harris to go to Central Africa and talk about, we want to do the partnership model and work together and so on and so forth. And, again, the Chinese, with respect to copper, with respect to lithium, I mean, you can sort of go down the list. They were having these conversations and striking these deals years ago. And look, I mean, I'm not, maybe I'll leave it to Velina to comment on some of the geopolitical aspects of these relationships, right? But, I think the Chinese have a different view of how to approach countries, not just in Africa, I mean, other parts of the world as well, and kind of the deals that they are willing to make. And I think that the United States has a slightly different approach. I mean, we just potentially value or focus on different things, or we have certain standards that we are not willing to breach, whether or not it's human rights or environmental challenges. And, I don't want to paint the Chinese relationship with African countries and the U.S. relationship with African countries with a single broad brush, because, situations I think can be very nuanced. But, can we compete? Yes. Okay. The question is how? Well, we need to start spending quite a bit more time in these countries and, quite frankly, quite a bit more development capital. Most of the development capital that I have seen has come from the private sector, for better or for worse. And so, I think that's the way forward with this relationship. I will say, just one interesting thing, just to maybe for one moment, just get away from Africa. You are starting to see, I think, the Chinese lithium ion supply chain also reconfigure itself. I mean, for all of this talk about decoupling and de-risking from a US or North American perspective, it looks like the Chinese, in my view, are trying to do something similar. And so you have major Chinese players in the EV supply chain, like, for example, BYD, right? One of the largest, I think the largest EV automotive manufacturer in the world by sales. They sort of go neck and neck with Tesla. But my point is, look, they are vertically integrated. They are involved in mining. They are involved in all aspects of the supply chain. They have had $1 billion proposal to set up a factory in India. And the Indian government broke up the deal and pushed them out and would not allow a Chinese company, under the guise or the auspices of security concerns, to set up an electric vehicle plant in India. So, the raw material aspect is a very important piece of this whole discussion about how, we compete and who's doing what. But you also, I would just want to say, are starting to see a little bit of pushback on Chinese efforts to go to different countries and vertically integrate as well. I mean, I think there's also an interesting kind of a side conversation to be had here around the Belt and Road Initiative, what that means and how successful or maybe unsuccessful a challenge that has been and will be in the future. So I don't want to get too far off track and ramble a little bit here. Let me stop there. But the short answer is, from a U.S. perspective, we have a long way to go to compete with the Chinese in Africa.
Excellent. Thank you. Now we're going to go back to Velina because I want to talk about Europe a little bit here. And this is kind of a multi-part question. So you spoke a little bit about, I want you to go into a little bit more detail about Europe as far as the energy situation is concerned, because, obviously it seems they've become complacent now that gas storage is full and prices have come down significantly. They're back on this green energy war path with unrealistic goals. So is it going to take another energy crisis for this mentality to change? And as well, first answer that and then I'll go on.
Oh yes, Tracy, absolutely. And I argue that we are actually likely sliding into winter crisis, energy crisis 2.0, without even understanding the reality. I mean, the complexity of the reality as such, similar to what we were trying to give as an example on the topic of the food crisis. And here, some examples have been already given. The main point is that there are still a lot of issues that haven't been addressed. Last year, yes, you rightfully pointed out the storage capacities are full, but we are still in the middle of a summer. We are already seeing the implications of a very, very extremely hot summer in some parts of Europe, such as the case with Spain, southern Italy, Portugal. We don't know how long it will take. Think of electricity, and here we also have issues such are the issues linked to the energy transition agenda. We have a complete mismatch in my personal view between energy security in short term and energy transition in long term, because political decision makers do not want to give any green light for long-term oriented projects that are linked to fossil fuels, specifically, of course, the main sector, which is the gas sector. Here we have a lot of issues. We are still lacking around 40 BCM on the global markets, which are practically coming out from the missing Russian gas volume, and obviously with a much better outlook for the second half of the year, specifically regarding the Asian markets. I argue that once European politicians are coming back from 2 months summer vacation, and all those who are taking the decisions are going to wake up to a very unpleasant reality. And I very much hope that once again we will be lucky, because last year we were simply lucky with a very, very mild winter, with 700 billion that the European Union spent on mitigating the risks. I really want to highlight the sum 700 billion, because you could imagine what this kind of sum could have as an impact if it would have been invested instead of being spent to mitigate the effects from the immediate effects from the energy crisis, because Europe was already in a crisis in 2021, and with the beginning of the war, this crisis has been obviously amplified. Now, another point, of course, so long-term deals, for instance, with suppliers such as Qatar, are still missing. Some initiatives were launched, such is the case with the new platform in Brussels, European Union Energy Platform, where suppliers can actually offer certain amounts of gas, mostly natural gas and LNG, and then there are collective purchases. So so the first round was already successful, with around 13 BCM being purchased that way. But as I said, given the fact that Russia still has some leverage, Nord Stream and the pipeline to Poland is actually out of the equation. But there are still two other components of this equation, and the next could be that the transition via Ukraine would be practically blocked by Kiev, given the circumstances of war of attrition. So that would mean that an additional amount of the gas would be also out for those clients in Europe that are completely dependent, and we still have such cases in Europe. So it's disproportionately dispersed. This kind of dependence is disproportionately dispersed. So some have been more lucky, for instance, because they could diversify away from the Russian gas via LNG terminals. But others are not so lucky, and that is why they will be dependent, of course, on the so-called solidarity. And we've seen that solidarity in times of crisis is not always working the way we want. Think of the pandemic and how actually borders were closed once things became messy and quite serious. So once again, long and hot summer, and then a nasty winter, and then a very, much more positive outlook for Asian markets. The missing long-term contracts the missing volume of, as I said, around 40 to 45 BCM on the market, and more or less, this kind of inadequate, in my view, from a geopolitical point of view, push for energy transition in the middle of an energy crisis and in the middle of a war, where even Sweden, which is a country that is a front runner in the energy transition, has abandoned its 100% renewable energy goal, and given the fact that we still have a lot of animosities between the European Union member states, because some are nuclear powers, some are non-nuclear powers, and there is a lot of political struggle, a lot of fighting actually in Brussels between these two big blocs. So you have a lot of issues where energy security has to be put first, and these issues have to be solved. Instead of doing so, a lot of political agenda is being pushed for the sake of, as you know, political ideology. And this could be, I think, tricky and risky, and could, in fact, result in a looming crisis in a looming energy crisis 2.0.
And do you think, I mean, we're kind of seeing, we are seeing deindustrialization happening and manufacturing happening in, Germany, once powerhouse of manufacturing of the European Union. I mean, do they let this continue? Because obviously it's due to many of their energy policies, so to speak. So in your opinion, do they realize this at some point? Or they're going to let their economies kind of go down the drain for the sake of green energy?
I think that right now this is really about ideology, and they are all like in this kind of mood that I think that also it lacks a lot of the technical expertise to understand the complexity of these problems. We have a lot of interlinked geopolitical and geoeconomic and technical problems in the middle of a fourth industrial revolution. So we see that our political decision makers are just not fit for the job in general to understand these complexities. And I think that it is a snowball effect already. So what we are seeing meanwhile, it's a manifestation. It's just the top of the iceberg, but they are in the middle of the process, and they cannot stop it from further going south. So in a sense, my main argument is that reality will punch them in the face very, very hard, very, very soon. I hope, of course, that I'm wrong on that matter, but once it happens, it will be, in my view, too late to, in fact, launch any significant measures, except for the one that they know already, and that is to spend more and more money and more, hundreds of billions to mitigate actually the effects of already taking decisions. So yes, this technical recession of Germany that you pointed to is going to continue. The protracted energy crisis is going to further wreak havoc on not just the German economy, but by extension, the broader European economic scenario. We see already not just German companies, but in general, other European companies leaving the continent for the sake of cheaper and more secure energy supply. And in a sense, I think this is a systemic process. It's not just one specific manifestation of it. And this, of course, will result in a lot of political turmoil, with a lot of political reshuffle, unfortunately.
Thank you very much. And it's unfortunate for Europe, definitely. So moving over to Peter again. So talking about, we're seeing, everybody was thinking, a month ago, sigh of relief. Deflation has come here, right? And now we're obviously seeing, you know, oil prices break higher, product prices break higher, agricultural prices break higher. Obviously, none of this is deflationary. Housing prices, as we talked about earlier, going higher as well. And this is even after the fastest rise in rate hikes in history, or one of them in the United States. So, you know, what is going on here, really?
Well, it's Jay Powell's worst nightmare is to get the disinflation that he's been shooting for, and then to see inflation pop back up again. And now people have to keep in mind that getting inflation down is one thing, keeping it down is another thing, and that is why I think the bottom line is we're in for inflation volatility. We are not going back to a 1 to 2% inflation rate on a sustainable basis. And I emphasize sustainable because, yeah, maybe November, December of this year, early next year, we see two handles on inflation, or even a one handle on inflation. But that's not the victory. That's a win in a battle, but that's not winning the war. It's keeping it there for quarters, for years at a time. And I think that's where he's going to have the most amount of difficulty. But it also is why he's going to remain really tight with monetary policy for a while. And while I think the markets, and I say for the stock market has rallied, credit markets have remained pretty tight in terms of spreads since the October lows. It's been the Fed is scaling back their rate hikes, and now it's the Fed is almost done hiking, rally. But I think there's just been a lack of appreciation for what it means to have high rates for a while. And not in itself, but it comes after 15 years, I said earlier, of zero. When you have 15 years of zero, when you think about when a business or a household borrows, it's really the only 30, it's the 30-year mortgage is really the only long-term loan that somebody takes out. Yeah, there's some high-quality credits, investment grade that can borrow out 10 years, 15 years. But outside of that, most of us, particularly in corporate America, they're borrowing either floating rate or they're borrowing out a couple of years. So every single day that passes us by, and I mentioned earlier the person who gets hit by an adjustment to their adjustable rate mortgage, but what about the business that has a loan coming due? Chances are the interest rates on offer today are at least double the rate on the loan that's coming due. I mean, the cost of capital for corporate America right now, outside of the highest quality credits, it's like 8 to 12%. You know, the world's economy was built on a foundation of half that, and obviously zero for sovereign governments, and below that if you happen to be in Europe or in Japan. The world, from a credit standpoint, a debt standpoint, an interest rate expense standpoint, was not built to last on these current levels of interest rates for a long period of time. Now, that said, positive real interest rates over time is a good thing. Having smaller central bank balance sheets are a good thing. But the transition from here to there is going to be extremely disruptive, extremely painful, and this is going to be a multi-year, drawn-out process. And just to give one last example, you know, if I'm in real estate and I bought a property in 2021 and I was not savvy enough to really extend that out for a long period of time and took a 2-year loan on it, well, that loan's coming due at the end of the year. And while maybe today I'm not impacted, you know, the train's still coming down the track towards me. And I'm either going to have to stump up with more capital, or I'm going to hand back the keys, or I'm going to have to restructure the loan with the bank. So there's a lot more sort of monetary tightening to be had, even if the Fed stopped raising interest rates today. Because higher for longer is a continuous form of monetary tightening. And then, of course, you throw in QT and all that, and what that means. And it's anybody looking for just a quick fix here once the Fed's done raising interest rates, I think is that thought is misplaced.
And do you think maybe fiscal policy is kind of butting heads with monetary policy right now? Because we have all this government spending, and yet you have the Federal Reserve trying to do the opposite of that.
Yeah, it's exactly right. So you can throw that into, okay, so we're seeing disinflation, there's no doubt, and we're probably going to see continued pace of it, particularly on the service side as rent calculations within CPI comes further down to reality. Reality right now is probably rent growth. If you include an existing lease or a new lease, it's probably 3 to 4% rather than 8. But now you have, as you mentioned, the curl up in commodity prices. Yes, you have all this fiscal spending, particularly in U.S. manufacturing via either grants, tax credits, loans. Local governments, people forget local and state governments were given hundreds of billions of dollars through COVID. There's like 350 billion that hasn't even been spent yet, and by next year needs to be spent. So there is that enormous amount of spending, again, via outright outlays and or subsidies that is going to create a level of demand that wouldn't have happened otherwise and put a floor under inflation. And then you have to wonder, with all these union labor contracts that are now being struck, even though the private sector union percentage population is only about 5%, it's almost non-existent. A lot of these unions, the deals that are coming due that they're trying to renegotiate, these deals were struck pre-COVID. These deals were struck when inflation was much lower. So a lot of these unions are trying to play catch up, and you wonder what sort of signaling effect and symbolic effect that has on the rest of the private sector that says, hey, that UPS part-time worker is now getting north of $20 an hour. That other full-time guy or gal is getting $50 an hour. I want that. And that also potentially could keep a floor on inflation. Now, I want to just say one quick thing here. The Phillips curve was not meant to say that there's a tight labor market, that means you have higher inflation. It was meant to say there's tight labor market leads to tighter wages, which may or may not lead to higher inflation. But it is something that Powell has talked about. He's got his eye on wages. He's worried about that filtering through into further price increases. So all in all, bottom line, be prepared for inflation volatility. We're going to get the benefit, and we've had from disinflation, but that doesn't mean inflation stays low. And that means, all in all, Fed's going to stay tight for a while with monetary policy.
And you think that, it's FOMC day, so I assume you believe the market's right and we're going to get a 25-point basis hike. Or maybe you don't, if you don't say so. But do you think do you think that this is it? What is your view of maybe the path that they're going to take? Are they just going to keep raising rates until something breaks per the usual? Or kind of tell us what kind of path you think that they're going to take? Or, to the best of your ability, we won't hold you to it.
Well, they're certainly going to hike today, and they voting members essentially told us that. What they do thereafter, I think Powell is going to leave himself open, but he is not going to let the market get away with the thought that just because they're done hiking, that means they're going to quickly pivot to cuts. He is focused solely, and I emphasize solely, on his legacy right now. He can give two shits, excuse my language, about Biden and the politics of how he runs monetary policy. He doesn't want to be remembered as the guy who not only stoked inflation, but couldn't get it under control. And he's willing to make sacrifices for that. And that gets into his expression most likely today that he's not going to rule out another interest rate increase there in September. He is not going to stop with balance sheet shrinkage because this inflation battle is not won just because the rate of change is going down, or I should say rising at a slower pace, but it is not only just getting to around his 2% range that he likes to target, but staying down at those levels. Because the lesson from the 70s, I'm sure we all know, is inflation spiked up beginning in the late 60s. then moderated in the early 70s. Central bank got complacent. Then we had the flare up. Then they tightened policy. Inflation fell. They got complacent, and then culminated in the late 70s, early 80s of double-digit inflation, double-digit interest rates. He's got that chart essentially posted on his mental wall and on probably his physical wall in the Eccles building in DC. And he doesn't want to repeat that. And I think that's going to be the most important thing that he's going to emphasize. But yes, to your original question, fiscal policy makes this really difficult for him to pull this off.
Thank you very much. And then we'll move to Chris and talk about kind of the batteries metals markets a little bit more. So first, China's obviously the largest supplier of rare earths, which we talked about are not that rare. And you have Europe and the US talking about wanting to decouple from this, as they stated. I mean, is this even possible at this point?
Yeah,
Chris?
sorry about that. You know what? My phone rang in the middle of your question. I'm sorry. You were saying that China is sort of.
Did you hear me?
I heard.
Yeah, basically.
Go ahead. I'm sorry.
The question was, Europe and the US are talking about they want to decouple from China, obviously being China the world's largest supplier and producer of rare earths, obviously not that rare, and other products such as solar panels. So is it even possible for the US and Europe to decouple, as they say they have stated, as they have said they stated they wanted to do?
It would take. Yeah. It will take. Assuming we're all serious about this and we have the capital and the political will and the patience to truly decouple or de-risk or whatever that means, it will take decades to do that. Honestly, depending upon where you look at on the supply chain. China only mines about 13% of lithium globally. But when you go further down the supply chain, they refine, meaning take the raw ore and then upgrade it to battery grade material. They refine about 60% of global lithium. And then as you go down further on the supply chain, cathode production, anode production, and battery production, they produce anywhere from 65 to 80% of all of that material. Okay. One of the things that I think is interesting about this whole decoupling debate is that, I'm based in Washington, D.C., and the view on China, okay, from the standpoint of the U.S. government, is about the only thing that I think Republicans and Democrats can agree on. China's the bad guy. They're evil. We're going to decouple and go our own way. But corporate America, I think, has a much more nuanced view of how to interface and how to deal with China, right? And all I guess I'm trying to say is, while the U.S. government would at least, if you take the sound bites at face value, the U.S. government, the Biden administration is intent on decoupling from China, whether or not it's with respect to semiconductors or battery production or just high tech in general. Corporate America, again, is a much more nuanced view, okay? And there are a couple of very tangible examples along the battery supply chain. Of course, Ford and CATL. CATL, for those of you on the call who don't know, is a Chinese company, about 80,000 employees. They are the largest lithium-ion battery producer in the world. And Ford and CATL have a plan put together to build, cooperate, not co-own, a battery production facility in the state of Michigan. Okay. Ford, I think, realizes, look, if we are going to electrify our fleet and have any chance of quite frankly being profitable doing it, we're going to have to rely, at least initially, on Chinese technology. Okay. Now, that's just being pragmatic, right? And another example of what Ford is doing, I think, to diversify their supply chain or grow their electrification supply chain, is they are also in Indonesia, but they have entered into a joint venture with Vale. They're a Brazilian company, but they have a big nickel operation in Indonesia, as well as a very large cobalt producer in China called Huayu Cobalt. Those three companies collectively have committed to spend about $4.5 billion, and Ford will spend about $1.5 billion of that $4.5 billion on developing nickel supply coming from Indonesia, which, just as a brief aside, Indonesia is not a free trade partner of the United States. So that material is not IRA compliant, which is a separate interesting discussion to be had. But I guess my point is that, as I think about what decoupling or what de-risking looks like, 5 or 10 years from now, while the U.S. government would prefer to accelerate it, move away from China, and have our own kind of separate regionalized supply chains, which will be higher cost, by the way. Corporate America, I just don't think is, I don't know if they're willing to do it or not, but they're certainly not ready. And that's why you see companies like Ford, just not even quietly, like out loud, doing these deals with Chinese companies. And of course, that Ford and CATL deal has attracted the attention of policymakers here in Washington, D.C. I actually have on my desk a letter that Representative Mike Gallagher, he's the chairman of the Select Committee on China in the House, and Representative Jason Smith, who's the chairman of the Committee on House Ways and Means, have basically gone to Jim Farley, again, CEO of Ford, and said, what are you doing? Like, this is not the way this is supposed to work, and I've seen interviews where Senator Joe Manchin has been asked about Chinese investment in the United States or Chinese partnerships along the EV supply chain. And somebody asked him point blank, will that battery qualify for IRA subsidies? And, he said, absolutely not. And so you've got corporate America basically, reading the tea leaves, if you will, and saying, we just cannot decouple and run our business and do so profitably in any given realistic time frame for our investors and for our shareholders and for our employees, for that matter. And so it's going to take a long time to do anything resembling any kind of de-risking or anything in that regard.
And then, as far as I just wanted to talk about, current U.S. EV market share is about 7.6% right now. And, you have the California goals, their 2030 goals, and we have Biden's 2035 goals, I believe. I mean, obviously, getting to the numbers they want to get to is, I believe, virtually impossible. Even just from an infrastructure standpoint, I mean, is that true or not? I mean, can our grids handle that? And how much do we need to spend on upgrading our grid system in order to even handle that amount of influx of electricity needed?
Yeah.
And there's really no money for that. I mean, nobody's allocating money for that, really.
Yeah, nobody's allocating money for it. I mean, the quote unquote cost of the Inflation Reduction Act, I think, was estimated by the Congressional Budget Office at like $370 billion. And when you kind of think about what I would call the true costs are, like upgrading the grid and deeper EV penetration or grid scale energy storage penetration, I mean, it's going to go over $1 trillion, no problem. I mean, again, this isn't a technology limitation question. I mean, we can upgrade the grid. We can, electrify transport. We can even withstand a lot of the volatility in metals prices. Just as an example, I mean, from trough to peak, lithium pricing in the current cycle went up about 1,100%. Okay. And yes, you saw volatility with nickel, volatility with copper, cobalt as well. But all that did was that increased battery pricing by about 7%, okay, to about $150 a kilowatt hour. So you sort of have to think about this whole shift, if you will, on almost a metal by metal basis. But again, I guess, Tracy, to get to your question specifically, I mean, we can certainly upgrade the grid. It's just a question of allocating the cost and the political will to do it. Your question kind of goes down a rabbit hole a little bit of, well, what does the optimal battery look like in the future? And what does that mean for the grid? And that's also changing as well. I don't want to get in too deep into the weeds today. But it's doable. But again, coming back to, I think, my original point, None of this is doable without a reliable supply, okay, of the raw materials, be it copper or lithium or what have you. And that is where this whole shift, if you will, whether or not it's decoupling or electrification, this is where the shift is going to take longer than I think many people would likely hope, to sort of, I think, echo what Velina had mentioned.
Excellent. And really, I still have a million more questions, but I realize that we're kind of running over the hour. So wanted to go, we'll end with my normal final round, which is final thoughts. You can talk about something that we didn't get a chance to talk about. And then, there's a lot of investors on this space right now. So kind of for investors, what areas are you focused on, or what should we really be mindful of over the next, say, 12 to 24 months? And we'll start with Velina.
Thank you, Tracy. So several key theses that I have been propagating for the last, let's say, 15 to 16 months. First key thesis, and I think that markets and investors haven't factored in yet, is the emergence of Cold War 2.0 with all the ramifications for globalized markets, be it financial markets, commodities, but also obviously being in the middle of a fourth industrial revolution. All of this is going to have a lot of repercussions. The inflation scenario as well. Why? Because the coupling, no matter how we want to name it, the risking, the coupling is not a unilateral step, as it was actually being suggested by many analysts for at least the last several years, but it is a mutual and quite of an objective systemic process. That means that China is also triggering and in fact amplifying this process, so we need to be prepared for that as well. So whether we like it or not, but it is already happening, and it is happening on all terrains with different of course, speed, different scale, and to a different extent, but let's not get fooled about it. So second key thesis is that if, and this is more about Europe, with the largest and the most serious war going on for 16 months, and yet no war economy, no preparations to avoid a war of attrition on behalf of the political decision makers in the European capitals and in the European institutions. So they are all still in the bubble, as if this thing is just a minor, geopolitical event that is going to be away at some point of time in the future. Nothing of that sort. War of attrition that we unfortunately may continue seeing in 2024, 2025. And you get the idea what it means specifically for the energy markets, but also for food commodities and for all these kind of important raw materials. Third point, third key thesis is that not everything is obviously pessimistic. On the opposite, it will this kind of systemic conflict will create a lot of opportunities, and this is where investors need to look for the niches. There will be buffer zones, gray zones, where key players will manage to maximize their gains, will manage to navigate between the two players without practically getting attached to the one or the other. This is, of course, a transitionary period where the new world is emerging, the old world is dying, and we are in this gray area. We don't know for a fact how long it will take, but it will create a lot of investment opportunities, and we already see the positive effect. For instance, in a geographic zone such as the Middle East, which is now, by the way, called West Asia. You get the idea, because specifically South Asia but also Central Asia are going to increasingly play a role. So Central Asia are already capitalizing as well, for instance, by helping Russia to bypass the Western sanctions. South Asia, specifically with India being at the epicenter of the global and regional reconfiguration of supply chains. So not everything is bad, but prepare for the worst, hope for the best. And here, of course, what we are going to see is not only make America great again, but actually make every important geopolitical state actor great again. We are going to see a very similar agenda coming out from most of the key regional players. First, because they are very much afraid of getting caught in a binary scenario. So that means having to decide between two options. And second, because of the problems that Chris and also Peter already outlined, namely that when it comes to supply chains, when it comes to food commodities, when it comes to energy, raw materials, minerals, not a single actor, including United States, will be able in the future, in this transitionary period, will be able to act on its own. So those players who will be able to forge powerful alliances, workable partnerships in all these important areas will be on the winning side. So here we will see a lot of ad hoc, fluid and diverse partnerships, and at the same time, it will be centered around a very unique agenda of how to, make sure that all the supply is secured. And specifically, again, the positive news, because I really want to end with positive news, is that it will create a lot of opportunities. Competition per se creates a lot of investment opportunities from the defense sector, space sector, all of cyber, hybrid, all of this kind of warfare, which is a bad word, of course, warfare kind of operations and agenda. It can be, from which it can be derived that a lot of demand is going to cause obviously new kind of investments, and we are already seeing that. So I will conclude with this kind of outlook that, in my view, we are not beyond global food crisis 2.0. We are not beyond energy crisis, at least when it comes to the old continent, energy crisis 2.0. There are still a lot of writings on the wall, in my view, and unfortunately, the biggest loser will be the global south, as the terrain, so to say, that is mostly affected by this global regional competition, and it will very much have to do with the way how the war is going to continue. But let's not be fooled, as I said, that we are going to see an end of the war in 2023. Thank you, Tracy.
Thank you very much, Velina. And next, Peter, the same question, kind of touch it. You can talk about something that we didn't get a chance to talk about that you feel is pertinent, or kind of just what should we as investors really be focusing on for, the next 12 to 24 months?
I just want to just reiterate that, well, investors just need to understand that we're in a different environment, completely different with this higher rate world, that the days of zero rates, QE, easy money, at least for a while, those days are over. And if you're continuing to work sort of the same playbook that was so successful when we were in that very easy macro monetary environment, I think you have to understand that it's a new world. And I comically gave an analogy in a piece I wrote months ago. If anybody had seen the movie Dazed and Confused, the Matthew McConaughey character, David Wooderson, was this mid-20s-year-old guy who just couldn't give up and walk away from high school. And all he did was hang out with high school kids and go to high school parties. And I want to say to him that high school is over. I want to say to all the investors out there that, again, zero rates in QE world is over, and we need to adjust. But unfortunately this year, and we've seen this from the October lows, with the S&P 500 trading at 20 times earnings, with what we're seeing in this whole AI craze, with meme stocks and this and that, is people think that somehow the Fed being done, almost done with raising interest rates, that we're just going to go back to that world. And I just don't think that is the case. And I think that we have to acknowledge that this is going to be a drawn out process in terms of acclimating to this higher rate world. And I think acknowledging that, I think, is important. And unfortunately, too many people that I'm seeing think that we're just going back to the party on days that we so enjoyed for so long in a zero rate world. So I'll stop there.
Excellent advice. And last but not least, Chris, same question.
Sure. I think, yeah, look, just to kind of echo Peter's sentiments, maybe a little bit more focused on supply chains. We are in a new world, right? There's no playbook for how to build a resilient or, regionalized supply chain, whatever that means. And so, again, over the next 12 to 18 months, what do I think you're likely to see in the supply chain? Well, look, we're coming into an election year here in the United States. So China and its actions in the supply chain are only going to come under more scrutiny, which could tighten markets and I think add volatility to some of these metals, specifically lithium, as I keep coming back to. But again, there's a case to be made for some of these other metals as well. So a lot of continued tension with China. And then, on the other side, so what is the takeaway there? Number one, I think you're likely to see OEMs, General Motors, Ford, even the European players, basically just continue to get more aggressive. In other words, they're not going to rely on their battery partners or their suppliers to go out and make investments. We've seen General Motors commit to invest $650 million in a near-term lithium production mine out in Nevada. Ford has done the same thing in Western Australia. You're likely to see these large OEMs, the folks with the big checkbooks, just get aggressive and try and accelerate this push to make sure that they don't have to lay awake at night worrying about security of supply. Of course, you can put as much money in a bazooka as you want and blast it at these large industrial projects, but it does not accelerate them. Okay. And so that's really the challenge I think that we face in terms of building out a domestic battery supply chain. And so, where else am I focused? Again, not just sort of the next 12 to 18 months, but going forward, I'm just really interested in battery technology. As I mentioned before, I have a Google alert that kind of blows up every week with the latest and greatest, but there's so many smart people working on the ways to shrink batteries or use less materials or use different materials. And so I spend an awful lot of time looking at different technologies. For example, vanadium redox flow batteries. What are those economics? What are they good for? Where are they produced? Sodium ion is another battery chemistry that, a lot of people I think can compete. Or a lot of people think, I should say, will be competing with lithium ion a little bit later this decade. So spend a lot of time thinking about that infrastructure as well. And I think that's an interesting place to sort of focus in the near term. So again, thanks everyone for coming, and thanks Tracy for the opportunity.
Excellent. Thank you. And thank you. I guess I know we ran over time a little bit. I really want to thank you for your time today. Really appreciate it. I know everybody on the space listening also appreciates it. So everybody make sure that you follow these three. They post a lot of really good information. They are fantastic. I follow them all. And follow Place Your Trades, of course, to see what else we have going on over there. We have a ton of stuff going on. Kind of new exciting stuff going on. So again, thank you guys very much for taking time today. And for the rest of the listeners, we will see you next Wednesday. Thanks, everyone.